We raised about $600 million, in fact, 600 million sterling in the preceding 3 or 4 years. In the 10 years that I was working with Ken at a private equity house called Gresham in the UK, we built a $1 billion fund. Unfortunately, selling a house is pretty complicated in today's world, but selling a business is probably at least 50 or 100 times more complicated than selling a house.
Welcome to the Superior Digital Show. My name is Jonathan DeCollibus, and our guest today has founded and built companies, some of which have achieved $1 billion valuation. He is the author of the book, Wrestling with Unicorns. Our guest and his business partner have personally masterminded over 100 successful company exits. He is an absolutely fascinating individual, legend in the business world, veteran of the game. Ladies and gentlemen, Mike Henebery.
First of all, hi John, hi Megan, pleasure to be here. Yeah, it's hard to describe how beautiful it is here. We're looking out straight over the Mediterranean, and Gibraltar's about 50 or 60 kilometers away, and I can actually see Gibraltar in the distance. Not sure if you'll be able to see it on the camera, but you can certainly see the Med there.
Oh my Lord.
So yeah, there's worse places to have spent the lockdown, I guess, and actually a large part of that time I was working and editing the book, of course. So it's a peaceful spot here, but we're only 10 or 15 kilometers from the town of Marbella and famous port of Banús, where the billionaires and the multimillionaires park their yachts. I'm not in that category.
Well, that's amazing.
I did have a meeting on a yacht recently, a fundraising meeting. That's about as close I've got to the yachts in the last few months.
I'd love to sort of just dive right on into it. I know, you and I spoke a little bit about this yesterday, just sort of in our preparation of this. And, most of our audience, is either in the tech space right now or they're migrating into that tech space, as you know. And I think the core, sentence that you brought up to me yesterday that really struck a chord was your fact that you shared that 90% of SME exits fail. That's really high. And I know that there's some very specific, precise, and exact reasons for that, that you're very well acquainted with, that you've discovered, that you've identified. So before we dive into some of the bigger picture, I just wanted to just give some big value up front, and just maybe if we can dive into maybe what are those reasons? Why do you see that as the situation today?
Well, first of all, a little bit of background, John, on me, ex-to Valhalla, and my colleague Ken Lawrence. Ken and I really have spent our entire careers devoted to raising finance for growing and exiting small, medium-sized enterprises, and typically those companies have had revenues between 10 and 100 million. And we've often been involved in making bolt-on acquisitions to those companies. So I think in the 10 years that I was working with Ken at a private equity house called Gresham in the UK, we built a $1 billion fund almost from zero, because it was a spin-out from Zurich Financial Services, which is quite a large insurance company here in Europe. Obviously, a private equity firm was non-core, and following the sad events of 9/11, a lot of insurance companies had a capital crunch, and of course private equity is capital intensive, so our spin out became inevitable following 9/11, and that created an opportunity for us as the managers of the business to lead a buyout. I was in my mid-30s, but I was the chief investment officer of that business, and it was the acquisitions that we'd been making in the early 2000s just prior to that which gave us the kind of returns that would attract independent capital, because of course shifting out of Zurich was an opportunity, but it was also a challenge because we had to raise external capital from financial institutions, and we raised about $600 million, in fact 600 million sterling in the preceding 3 or 4 years between 2002 and 2006, and that's if you like was the core of how we built this billion fund, which technically, I don't even think the phrase unicorn was even invented until 2013. But there we were, building a unicorn private equity business without actually knowing what a unicorn was at that time. But I guess the most important thing is that Ken and I have devoted our entire careers to working with management teams to build better businesses, to grow those businesses, and to exit those companies. And Ken is a particularly interesting character because he's masterminded over 100 private company exits. And it was in the course of back end of 2019, I was thinking about what to do after the journey that I'm on at the minute comes to an end. And we'll probably touch on the digital fashion company that I've been involved in for 3 or 4 years now. And that's probably moving towards an exit in the next couple of years. I'm not really a digital fashion guy. And I was beginning to sort of look to the broader future. And I guess I went back to my roots and thought there's a big opportunity here with a lot of digital convergence, which allows you to offer consulting services online, much in the way that Frank Kern is doing it very successfully in the US. And Frank is somebody we look up to as kind of the godfather, really, of internet marketing. And we love everything Frank does. We follow him. We've even invested in the Sandor system, which he's releasing to encourage people like us to provide these consultancy services, because he understands that even he, with his resources, can't fulfill the need. There's such a big need out there by and from entrepreneurs for these kinds of sales growth and profit improvement services. And what I've done is tried to tailor that around exit, because Ken Lawrence has got this unique experience. He started with Bankers Trust in the late 80s, and then with Montague, where we worked together. Montague is one of the biggest private equity houses in Europe, and maybe less well known in the US, but it's certainly a big private equity house in Europe. That's where I learned the ropes of acquiring companies in the late 90s, in my early 30s. And that's where I first started working with Ken. And Ken took a portfolio over 100 companies in Montague and slimmed it down to around 40 or 50 over a 4 or 5 year period, and then repeated that exercise at Gresham between 2000 and 2014, actually, before Ken left Gresham. So it's quite unusual to find somebody who's masterminded over 100 exits. And essentially all these projects are probably 4 to 6 months minimum. He's done IPOs, he's done trade sales, he's done secondary management buyouts. And I kind of invented the hashtag seen it all, really, for Ken, because frankly he has. And whenever you come across a challenge, and we're working with a management team in a North of England based business at the minute, which is going through incredible growth with some software that they're selling into health ministers in governments in Africa and Latin America. And Ken basically was referring to a deal he'd been involved in 1998 and wrestled with a problem that these guys are now looking to resolve. And this happens time after time with Ken. We come across a specific issue and he said, yeah, that's just like what happened to me in case ABC back in the day. And it's incredible to be able to draw on this resource of experience. And the reality is that there are very few things that we'll see, financial, legal, technical, or emotional. And of course, emotional issues are just as hard to resolve as the technical ones that Ken hasn't come across before. And so I thought it would be a good idea to create this vehicle, Exit Valhalla. I don't know if you've been catching up on your Viking programs on TV, but Valhalla was the Norseman's heaven. It was actually a place they went to fight and drink large quantities of beer. But I guess that was the idea of heaven for a Norseman back in the 8th or 9th century. And I guess what we're trying to say here is we can help entrepreneurs to create their perfect exit, their exit Valhalla. Particularly, of course, that's about achieving an exit, because first of all, you want to be one of those 1 in 10 companies that's actually successfully exiting. Over time, we'd like to make that 2 in 10. If we can make that difference, that's an objective we're kind of setting ourselves. When 90% of companies are failing, maybe we can help 20% of companies to succeed if we can do a good job of this over the next 10 years. Of course, not all companies are exitable, and there's a whole series of reasons which we can cover. But in essence, to answer your specific question about why companies are struggling to achieve exit, I think a lot of it revolves around lack of preparation. And that's partly because entrepreneurs, as Frank Kern points out himself, are largely suffering overwhelm. Unfortunately, if you're an entrepreneur running a small business, people probably only ring you up or come to see you if they need money or they've got a problem. And so you're constantly firefighting, solving problems. And I know this from our Fabify experience with the digital fashion company that we'll come back to in a little while. We've been running that for 4 or 5 years, and every day it's about fighting fires and solving problems and moving things forward. And that's what business is like when you're running a small company, And I guess I'm bringing some unique experiences. Somebody who's had nearly 2 decades as a private equity investor and then 1 decade as an entrepreneur. It's quite unusual to have seen life from both of those angles and to the scale and to the extent that I have. And when you referred to the 4 companies, I founded 2, in fact, were funds. One was the private equity fund we talked about. One was a private credit fund. And of course, private credit has gone through explosive growth since 2010, 11, 12, when I was setting up Palio, which was my private credit fund. But I can tell you in 2010, 11, 12, many people were looking at me as if I was smoking something very strong, setting up a credit fund. Why would you do that? And of course, entrepreneurs have to face that level of disbelief every time they go out to raise money. It's very rare that investors immediately buy into the opportunity that perhaps you see because of your insight in a particular area. And I could see as a private equity guy that there was a problem with private credit, that the banks were unlikely to be able to fulfill the need that private equity would have. And you're probably aware, John, that when private equity investors buy a business, usually at least half of the capital to buy that business, rather like when you buy a home, comes from debt. So in the old days, it used to come from the banks. But the US, when it went through its banking crisis in the late 90s, early 2000s, had shifted towards more of a fund model for private credit. And I could see that was going to happen in Europe. And that's why I set up Palio. It didn't quite happen thanks to what I call a rogue regulator, but we don't need to go into too much detail about that. But essentially, having raised around 130, 140 million for a startup in 2012, which I can tell you was a heroic achievement by my team. It wasn't just myself. I'm a big believer in collaboration. I had 2 fantastic guys working with me in that business, and Ken Lawrence was actually involved to some extent as an investor too. So there's really 4 of us on that journey. And unfortunately, we had a green light in London, one of the highest regulated financial markets in the world. But we were dual listing in a small offshore territory called Guernsey, which you may not be aware of or may not be so familiar in the US, but it's just between the UK and France. It's actually technically closer to France than it is to the UK, but it's an offshore tax haven to the UK. And if you want to attract investment trust money, which is basically tax-efficient money, tax-efficient institutions, then you have to do a dual listing. And the regulator there, unfortunately, gave us an amber light for no real reason that I can fully understand. And it was only in the course of researching the book that I found out the specific regulator retired 3 months later. So he was probably just looking to avoid a decision on his watch. Probably something he didn't fully understand, because what we were doing was highly technical and nobody was listing in 2012. There was the largest listing in London that year was of a new company. It was in the 60s. It was about a 67, 68 million. So for us to have 130, 135 in the pipeline was incredible. But essentially, because he put us on stop for 2 months, the thing about public capital markets is very attractive because capital can flow in quickly, but unfortunately it flows out quickly as well. If you try and put an IPO on ice, just talk to JB Dimon about that. He'll tell you that it's quite difficult. And unfortunately, 2 months of being on ice basically halved the size of our book and destroyed the IPO. But as I like to say, with my football analogies, and I played a lot of football as a kid, I am a team player, partly because of that. Even Jose Mourinho, who's a famous manager here in Europe, even Jose Mourinho doesn't shoot the referee when he gets a bad decision. He has to dust himself down and go again. And I had to do the same. And a few years later, I was working with Phil Harwood, my co-founder, on Fabify, which is this interesting scale-up we've got in quite a unique area of fashion, because we're connecting, essentially we're connecting big fashion brands with value-conscious consumers without damaging the brands, because we never mention a brand online, and yet we're offering incredible value to the consumer, because the discounts of these items usually range between 60 and 80 or maybe even 90% off the shop price, the retail price. So basically every consumer that buys on our platform comes back and buys 7 times within 12 months, which in the e-commerce space is a recipe for explosive growth. And Phil Harwood and I are planning a rapid scale up this year to get to somewhere north of 10 million revenues this year, and somewhere north of 65, 70 million next year. So that's going to be a very rapid scale up, but it's partly a function of the repeat purchases that we get. We've already had $100,000 checkout days, so we know this thing has incredible potential. We've only been marketing it in 3 or 4 small countries in Eastern Europe: Bulgaria, Romania, Greece, and Hungary. But they're good countries to test in e-commerce, because the cost per click is about 8 to 10 times lower there than it is in Western Europe. So you can, in the dash to break even that every startup has, you can get to break even a lot quicker in these Eastern and Central European countries. So that's the logic for starting there. But there's no reason that business model isn't capable of being brought to Western Europe and, of course, the US. And we recently rebranded that company to Fabify with a specific mission of taking it to the US in the next 12 to 18 months, maybe even sooner. Because if you want to have a unicorn, you've really got to have an office in LA, of course. And hopefully that'll be my job. I've always been close to the US, as I mentioned to you, John, when we were chatting yesterday. I have a lot of family in Boston. One of my co-collaborators on this book is a super famous businessman in his own right in the US, Tony Jimenez. Tony has a unique background as a former general in the US Army, but also set up Microtech in 2004, which is now probably the largest private company in the cloud, winning multi-billion-dollar contracts from the US government, amongst others. And Tony's kindly agreed to write the foreword of the book. He has an incredible network in DC, where he's based, but also in California. He's on the board of a company that also boasts famous film stars on the board. You know, so Tony's pretty well connected in LA as well as DC. I guess one other interesting thing is we're trying to reach out to entrepreneurs not only in North America but also in Latin America. And Tony has often been recognized as one of the most exceptional Latin American businessmen, because, of course, with a name like Jimenez, you'll guess he has some Puerto Rican background. So he's a famous guy in Latin America as well as North America. So I'm delighted that he's writing the foreword, and hopefully, you know, that'll give us some reach in the US. In fact, Tony did point out that the last time he wrote a foreword to a book was a friend of his who wrote the inside story of Intel. Tony wrote the foreword, and the book was on the New York Times bestsellers list. I said, thanks, Tony. No pressure there. But we're coming around to sort of talking about why companies struggle to exit. And first of all, I'd like to give a quick shout out to Jonathan Cross, who I came across on LinkedIn. He's quite a well-known investment banker, private equity guy, operating out of the Carolinas and New York. And it was actually Jonathan that pointed out on one of his LinkedIn videos last year and he bought a business broker in the US last year. So obviously in doing his due diligence, he'll know that 90% of these exits are failing. And when you come to say, why is that happening? I think a lot of it is going to be because of this overwhelm factor that SME owner managers, they think that they're going to sell a business. It's a bit like selling a house. It's going to happen. Unfortunately, selling a house is pretty complicated in today's world, but selling a business is probably at least 50 or 100 times more complicated than selling a house. And it requires preparation. At Exit Valhalla, we think that preparation should start at least 12 to 18 months beforehand. And the kind of issues that you should be thinking about in detail are, first of all, management succession. You know, you as the owner manager, you got three main options. You're either going, you're staying, or it's something halfway in between. And you really need to decide what that is long in advance of the preparation process, because obviously if you're going, that's going to leave holes in the management team that need to be filled. So the second thing we talk about is the management team itself. Have you got the right people in the right functions? And again, I go back to my football days. As a kid, there was a famous manager running a team called Nottingham Forest in the region I grew up in the UK, which was the Midlands. I actually played in the same team as Brian Clough's son, Nigel Clough. We played a couple of hundred games together. Nigel went on to play for England, by the way. We played many, many games together as kids. But his father used to say, in football, everyone needs to know their job. And that's the same in business. Everyone has a job, and everybody needs to know what that job is for the team to function. And of course, you're looking for the sum of the parts to be something greater than the individual parts. And that can only happen if everybody knows what their job is and everybody's working together. And in management teams, it's really, have you got the right CFO? Have you got the right chief technical officer? Digitalization is a big issue in today's world. Many smaller businesses probably don't have a chief technical officer, but I would suggest that considering appointing one, even if it's a part-time role initially, is a great way of identifying what investments you should be making. Have you got the right protections in terms of your digital defenses? Are you properly invested in big data? Data science, of course, is a massive issue in e-commerce, and any e-commerce company is running data models by the minute, by the hour, giving us feedback on what's happening at the checkout. But this is increasingly important to many, many businesses. So you've got to have that dashboard. It's got to be giving you the information that you require. And a buyer for a business is going to want to know what you've invested in training for your staff, in digitalization, really how far up the curve you are. And there have been many studies of this in Europe and the States, which indicate that SMEs, generally speaking, somewhere between 70 and 90% of SMEs are not properly investing in digitalization. So this will be a factor in failed exits. Then, of course, there's the product development pipeline, or if you're a service business, your service development pipeline. Are you properly investing in new products, new services? How's the evolution of your market changing? We're in such a fast-moving world, John, today. There's been many, many studies on this, that, we live in a world now where the rate of change is accelerating at a pace that no human has ever experienced before. So in business, that means you've got to keep up with that pace of change. And that usually means some kind of evolution in your product development or your service development to meet new market needs. That brings you on to organic growth, because, of course, product development, service development will be a feature of organic growth. But then we also talk in the book about moving into international markets. And again, coming back to this word collaboration, other than Tony's kind agreement to collaborate with the forward, I've had several people that I know in business help me with the international aspects of how you take a business into new markets. So there's a guy called Adrian Henebery who's worked with big companies like Airbus going into new markets, new geographical markets, not only in Europe but in Africa. And a guy called Mike Blenkinsop that Ken and I backed when we were at Gresham. We backed a company called Alea, and Alea had great success in China and in India and in other places in Asia. We talk a little bit about some of Mike's experiences and those of his team in a small medium enterprise, taking that business through joint ventures in some of these far off lands, which of course carry potential opportunities, but of course also huge risk if you get it wrong. So these are the factors that we tend to talk about. There's one other that we didn't touch on, and that's acquisitions. Bolt-on acquisitions is a great way of creating value as you're on the run up to exit. And certainly in the Gresham days, we were big believers in that. There was one of the stories in the book is about a company called 2E2. We bought literally for a pound, because the business had lost $9 million the year before we acquired it. It was owned by a Danish telecom company. It was a rather non-core business because it was a break-fix maintenance business around IT, largely dealing with companies that had below 100 or certainly below 200 seats. So not big enterprises, medium-sized enterprises, if you like. And 2ET would go in and look after these companies' needs. We had a fantastic management team. You don't buy a business that's losing $9 million the year before without the management team being absolutely top-notch. It was led by a superb entrepreneur called Terry Burt, and Terry's been kind enough to just review what I've written about that deal in the book, again, some collaboration to make sure the story stacks. But essentially, what they did with that business was turn off some loss-making contracts, shut a head office that really was superfluous to requirements. That led to a reduction in headcount and obviously some cost savings. And that began the turnaround. And that business was profitable within a month of acquiring it, which was an incredible achievement. We made upwards of 9 acquisitions in the next 3 years, and the company was sold for just under 150 million 3 years later. And that was one of the real building blocks in that Gresham fund that we were building between 2002 and 2010. That success within the 2E2 deal, thanks to Terry and his team and the way that we collaborated at Gresham with Terry, led to big success. But just one example there, I referred to the need for quite a few redundancies when we bought that business. We actually brought in a team from a completely different deal who had a guy working within the team who was a bit of an expert in HR. And he crawled all over the T's and C's, the terms and conditions of all of those people that were leaving and all of those people that were staying to make sure that there were no bodies buried. And of course, the devil's always in the detail, and I think in business, a large part of success is knowing who you need to call on to solve a particular issue. And in that particular case, it was a guy called John Springate, who has also collaborated in the book with the section that he's helped me to write on buying people businesses, because John is a bit of a guru in the area of acquiring people businesses. So we've got a section specifically devoted to some of the bear traps that you find when you're acquiring people businesses, what you look out for, and how you resolve those challenges. And really, this is what I've tried to do with the book, to draw on a lot of experiences, not only my own, but people I've collaborated with over the years, to try and give entrepreneurs a route map through how you go from a startup, how you raise money for a startup, how you scale businesses, whether that's through product development or through moving into international markets, how you begin to plan for exit, and how you manage that exit process. So really the soup to nuts experience of running businesses. And it may be that people don't want to read all the chapters. Maybe there's some chapters that are more relevant to them than others. And we've tried to structure the book so that you can see which chapters are going to be the ones that you need to focus on. And in that way, we've tried to make it a resource tool for entrepreneurs. And my hope, really, with the book is that there's something like, we reckon, somewhere between 10 and 20 million entrepreneurs in Western Europe and the US and Latin America who are probably thinking about selling their company in the next 5 years or so. And this population spike, which comes from the demographic boom, of course, which referred to as the baby boom, which of course I'm actually a baby boomer, being born in December 1964, the last of the baby boomers. But we think because of that, there's a mismatch in supply and demand. So there's more people selling their businesses than buying businesses right now, and that's making selling your business even tougher in the next 5 years than it was in the last 5 years. And in some ways, this is a bit of a black swan over the economy, because this is a huge wealth transition issue. If you think about the wealth transition from this generation to the next generation, it's important that these exits are more successful than they have been, so that these companies can move on in a profitable and successful way, and hopefully we can contribute to that.
Wow.
Mike, this is, I mean, you're covering such large pieces of ground here. It's a lot to take in, and I'm sure we will have a lot of follow-up questions to this, and I'm sure you'll be bombarded on LinkedIn and the different channels on your site as well with different questions on this. But I just have to ask you, I think one of the common themes that I see, not only with myself, but I see it with a lot of colleagues that I have who own very successful companies as well, is that when you think about the exit, I think, to touch on the first thing that you said about management succession, I think a lot of us are so tied into that, which is, I think, largely, that's been what has produced the success, right? Is that we've taken the complete ownership and we've invested. So how does someone make that transition to go from, I'm going to manage everything and I've always done it that way, to, well, maybe somebody else can come in and take my place?
Yeah, it's a process, but of course it's a process we only address head on, and part of it depends on your own ambitions as the entrepreneur, how you want to spend your time. Is your dream a retirement with no involvement in the business, or do you want a continuing involvement? I think you have to be quite upfront with purchases of a business, so that they can understand what your needs and requirements are, and then try and work with that and match them. But of course, to some extent, it comes back to this whole arena of the management team itself, because making sure you've got the right personnel in the right functions is critical. But all these things are solvable. They just have to be planned properly, which is why we tend to say that an exit is best optimized if you're planning 12 to 18 months in advance. It's not something that you start today and hope to complete 2 to 3 months from now. Right. Of course, you will have a broker right at the end, and there's an interesting analogy there. We have no wish to work as the broker. That's not our expertise. And of course, companies in different geographies and different sector specialisms should choose brokers that can meet those needs, meet the needs of that geography and the needs of that sector. But what we try and do is run the first 24, 25 miles of the marathon with you, so that when you get to the 25th mile, you're hitting it with the right momentum to get to the end of the marathon. And that's when we do the sort of handing over of the baton to the business broker, who can walk you through that final mile of the journey, which is just as important as the first 25, and it's just as much a specialized job, but it's not our role, So there's a critical distinction between what we're doing, really consulting to companies to help them to maximize sales growth, maximize profitability, make sure the team is in the right shape, make sure the investment is going in the right direction within the business, to create the right momentum for the exit. But a lot of it is just allowing the entrepreneur himself to lift his head up from the daily chaos of fighting the fires and solving the problems, to think a little bit more strategically, and just spend a bit of time at 35,000 feet figuring out what the direction of travel is and what the priorities need to be. And Frank Kern has a great throwaway line there, where he says most entrepreneurs, they're so overwhelmed they can't think about what the priorities are, and our job really is to make sure you're focusing on the 2 or 3 things that you probably need to focus on to optimize value.
If I can ask a question, you touched on something that's, I think, for us particularly relevant in the space that we're in, which is the value to a company that is looking for a profitable exit, the value for them to build in that as you very well said, the digitization, if that makes sense. Yeah.
This is an area that's been moving incredibly rapidly over the last 2 decades, since really the onset of the internet, the late 90s. I recall there's a great interview with David Bowie, where he probably showed more insight of the opportunities and the challenges that lay in the internet than some businessmen that I've worked with even as recently as 10 years ago, didn't have David Bowie's understanding from the late 90s. I think many business people underestimated what the internet would bring, both in terms of opportunity and challenge. And when you look at it from the perspective of a small business, it's really about figuring out where your interaction with digitalization is. So there's no one size fits all approach here, which is why I tend to go back to think about recruiting either a part-time or a full-time CTO who can help you to think through what the priorities are for your business, because maybe it's some sort of firewall security, data security, cyber security type issues. Maybe it's staff training issues. Maybe it's big data issues. Maybe it's something closer to the data science and the dashboard for the business to make sure the business is capable of making the right decisions based on the right information and up to date and up to the minute information. There's a myriad of opportunities and challenges that didn't really exist 15, 20 years ago because of the digitalization that the world has been going through. And it's part of why I was referring earlier to the acceleration of the rate of change. There's a very good TED talk by Alan Watkins, who's somebody that I set a lot of store by. I was lucky enough to be coached by Alan back in 2005. He's considered to be one of the leading business psycho analysts in the world. Has written 3 or 4 books on business leadership and how you get the most out of how you get the most out of yourself and your team in a business situation. And it's a physiological thing as well as the data science that we've just been talking about. It's a complex area, but Alan's one of the gurus globally on the subject. And he, in his TED talk, focused on the challenge that we all have as humans because of the rate of change and the acceleration of that rate of change. And the world has basically not been through anything close to this in human history. So the challenges that we face because of the rate of change that's happening all around us is something that you can't underestimate. And digitalization is at the heart of that. Think about Exit Valhalla. We're able to provide consulting services over Zoom conference calls like this to companies anywhere in the world. We can be having a conversation with a company in Latin America, North America, Europe, providing we've got the right language skills. Probably if you speak Spanish or English, you can communicate with most CEOs of most companies in Latin America, North America, and Europe. Yeah. But you could never have provided these consultancy services over the internet as recently as 3 or 4 years ago. But the acceleration of the quality of these kind of digital calls now means that you can. Then you've got platforms like PitchBook, which enable you to calibrate relative performance of companies in the same SEIC code in different geographies. So if a company comes to us in a particular SEIC code, we can see if their sales growth and their profit margin, how that compares with other companies in their sector. It was much harder to do this before the emergence of platforms like PitchBook. It's not the only one, but they're probably one of the global leaders in this area. There's one called Mark to Market in the UK, which is doing something similar. This whole area is changing rapidly, and it's giving consultants like Exit Valhalla access to data at a level that we'd never have had as recently as 3, 4, 5 years ago, at a granular level that we'd never have had 3, 4, 5 years ago. So, and this enables us to benchmark companies and see, is it a top quartile, is it a second quartile company in its space, and we can do that quite quickly. What we also say to entrepreneurs is the first thing we'll do when you come on our platform is we'll give you a valuation of the business. And again, PitchBook can help us to do that because it can tell us what comparable companies have been trading at in your sector. Again, information that wasn't really readily available at the fingertips as recently as 3-4 years ago. So we, in a way, we've recognized that this convergence is happening in our space. We've seen that Frank Kern is having success consulting to companies online.
Yeah.
But I've listened to Frank talk about his inability to meet the need. You know, the need is so great that there's no way that he can meet that need himself, which is why he's issuing this Sandor license to help other consultancies like Exit Valhalla to provide similar services.
Yeah.
As a private equity guy, one other thing that I've identified is that in the US, this whole area of consulting to smaller companies is very fragmented. And that tells you as a private equity guy that there's an opportunity to do a bit of a buy and build. And certainly that's part of our ambition with Exit Valhalla. We need to scale our business first. And in fact, this year's mission is very simple and yet very difficult, which is we need to find a way of being able to convert cold traffic from Facebook in a financially efficient manner. Because if we can't acquire new consumers through Facebook from cold traffic in a financially efficient way with a good return on ad spend, we're never going to be able to scale this company. You know, so we're working with, funnily enough, an American-based company in Florida, ROI Machines, actually run by a British guy, Rudy Moore, who has been incredibly successful. He's only recently turned 30. He's made a lot of money in the health and fitness space, and then recognized that a lot of what he was learning through social media advertising could be helpful to all sorts of companies. So he's doing a reach out at the minute to other companies like us to help us to build our funnels. But I like his phrase that really you have to master how you convert cold traffic in a financially efficient way, because if you can't do that, you're never going to be able to scale a digital business. So we're working with Rudy's team to create a funnel which helps us to capture people that are interested in our services, and then we'll be using the book actually as a lead magnet there to draw people in, because of course what the book does, and this is a lesson from another one of my favorite guys online, Jason Capital. If you're not following him, you should be. Very, very smart guy. Again, only 30 odd years old, but he has some pretty smart things to say about success online.
Yeah.
And,
no, Jason's on his game. He's
one of those things
very, very, very.
Is that if you want to be successful online, you have to be able to demonstrate mastery, proof and evidence of your mastery of a particular field. So, Wrestling with Unicorns, the book, is really to some extent our attempt to find a way of recording what we've learned over the last 30 years and demonstrating some proof and evidence, but also in a way which hopefully is accessible to help SME owner managers, because we've worked with SME owner managers all of our careers. We love doing this. You know, it's a passion. It's something we enjoy doing. I think it comes from this collaboration from childhood of always being part of teams, as I was usually on the football pitch or the cricket pitch, often the captain of those teams. Played with some great players both in football and cricket, and I think this has fed through into my business career. You know, I'm always looking for who the right person to collaborate with to provide the best value to the companies that we're working with. By the way, we're working with a company at the minute in LA. I mean, we're talking digitalization and the ability to provide these services over Zoom calls. I met a company through LinkedIn, a company based in San Diego, which has a very disruptive model around real estate, democratizing access to multifamily buildings in the US, which of course is a predominant residential or predominant area of the residential space in the US. What they tend to find is that these buildings they're acquiring are often pre-let 95%. In one case, one of the buildings they're looking at in their pipeline is pre-let 99%. So these buildings provide a very good rental yield, but they also tend to double in value every 6 or 7 years. So historically, the investment in this area has been dominated by large institutions, because to write the equity check, these buildings are going for $150 million, usually 60% bank finance, 40% equity. But that equity check was usually written by a big institution, an insurance company or the like. So what Unify are doing is fractionalizing that equity check and opening it up to high net worths through high net worth platforms, through financial advisors, essentially. So you could have 200, 250 high net worth fractionalized owners of a building, of a specific building, and they're managing all that as part of so they're leading the acquisition of the building. They're pulling in the debt finance from the usual sources, not just banks actually, but other more creative institutions as well. And then they're also providing the equity finance by fractionalizing it using some blockchain technology that they actually developed in another business, which they successfully built and exited. And this is something we're always looking for in private equity. You're looking to back managers. I talked about that 2E2 team, Terry Burt's team. They'd previously been on the acquisition trail, very successfully built up a NASDAQ business from $10 million to $250 million, but they hadn't benefited from the sale of that business to the extent that they should have done. So they were tortured souls to some extent. They'd done all the hard work, but they hadn't benefited financially from that. We identified that and backed them at Gresham, and it's similar, I think, with the Unified team. You know, they've shown success with their blockchain technology, actually in the payment system space, and they brought the same technology now to disrupt the real estate space. And I can see this is a company that should be a unicorn in 3 or 4 years' time. And actually, already 1 or 2 of the big VCs in LA are showing interest, and we've managed to achieve that from down here on the southern coast of Spain. So it's incredible what you can do using your contacts and your networks. But it transpired that I have a couple of very good contacts in LA who helped me to get into some of these big VCs and share the Unify opportunity with them. So, I think we're proving that we can help companies in the UK, companies in Europe, and companies in the US for sure. And we're enjoying doing that. I think I did mention to you, John, that I was lucky enough to spend quite a bit of time in Boston in my teenage years. So I always felt close to the US. Many friends have been working in New York for most of the last 10, 20, 30 years. So I've been making regular trips stateside really since I worked for Arthur Andersen in the late 80s. Of course, a great American company and a great culture. And one of my contemporaries actually from Arthur Andersen is a guy called Nick Cohen, who I misspent some time at university trying to match Nick in the annual exams, and I was scratching my head. I was working my socks off trying to catch up with Nick and just never could. Well, Nick's now chairman of Deloitte Europe. So
wow.
Really,
okay.
I was fruitlessly trying to chase it, but of course, you know what? It's good to chase the impossible sometimes. It takes you to levels that you wouldn't have got to otherwise, And I was lucky enough to know Nick at university and work with him at Arthur Andersen for a few years, and it's incredible what he's achieved. But that was a great business to be involved in, and I met many great guys in the Andersen years, which we do refer to in the book tangentially. And of course, you're always learning from people in that period of your career, in that crucial sort of 10 to 15 years of your career. It's almost, I think, as much about who you work for as which firm you work for. It's a bit of both, because you need the culture of the firm, but you also need the right technical skills and I would argue the right standards, ethos to learn from the right people. There's also a great line that Matthew McConaughey referred to in a recent speech. We're all chasing ourselves in 10 years' time, which of course is also true.
Yeah.
We'll never quite catch that person. We'll never quite catch them, but it's good to chase. It's good to chase.
It really is. And Mike, I got to just say, I think something that's really stuck out to me is, as you've been sharing this, is that all throughout the entire conversation, I've noticed there's this sort of a golden thread that's been woven in the tapestry of everything that you've been saying, which really, I think, has to do with the, and I think you touched on it a little bit explicitly, but I think really has to do with the psychology, the mindset that is required to be successful. And I think, you're someone that has really achieved a very significant level of success. And we are very, I think, very impressed by that. But I think the thing that really fascinates me, I think there's definitely, obviously, as you've shared, there's a huge amount of strategic and tactical work that you've put in to make that happen, in a lot of work. And, I can imagine quite a bit of uphill battles at points. So, what would you tell, the entrepreneur today who, even if they're not directly impacted by, let's say, COVID or something like that, but, how would you maybe encourage them or direct their attention with how to use?
Yeah. Well, I definitely recommend reading Alan Watkins' book, 4D Leadership, because it's, in my view, it's as good a summary of what you need to do, what you need to be thinking about to get the best out of yourself. Jamie Dinnan was interviewed recently saying that nobody can have success without hard work. I mean, that's obviously true. But I also think that anybody who's had success has probably also had failure. Warren Buffett is getting quite a bit of negative PR at the minute. I think I've been reading online. But nobody really in life has been successful without experiencing failure. I mean, how many times did Edison fail to invent the light bulb before he actually did invent the light bulb? Right. But he didn't knock himself down, did he? He just kept on going. He knew that to get to success, he had to go through failure. And I think most entrepreneurs understand that. And we touch on this in the book, that one of the challenges of being an entrepreneur is that to a partner in a relationship, it's not entirely clear whether you're going to the casino or whether you're building a unicorn, and of course, it can put a lot of stress and strain on relationships. And it definitely, startups definitely puts a lot of strain on your cash flow for sure. And some people may not be fully aware of the extent of those strains, but most entrepreneurs have probably been there, been either close to the precipice. Some have gone over the edge, but still bounced back. And I think part of being successful in business is getting up one more time. Then you're knocked down.
Yeah. That's powerful. Well, I just got to tell you, Mike, this has been what an amazing time, and I really appreciate you carving out the time today to spend this with us and to share the value, the insight that you've gained over your career. And I really am so impressed with what you've shared. I think this is going to impact thousands and thousands of people, who will be listening to this and watching this. I want to help.
That's the critical thing. We're here to help. That's the reason we've set this up. For us, it's a passion. Not all of these people have to be clients. Hopefully some will choose to be, but every relationship in business starts with helping people, and then it goes from there. And if it grows into a client relationship, great. But if we can help in some way, we're still happy to have added value.
100%. So obviously, our audience can go to Exit Valhalla DeCollibus.com here in the description below, guys. Please go ahead and click on there. Watch Mike's videos, watch his channel, engage with what he's got going on there. He's the best in the business, as he said about his partner Ken. I think we can apply to him as well. Hashtag seen it all. He's definitely the leader here in the space, and I would say for those of you who are interested in making that move, making that exit in the next 12 to 18 months, reach out now, because as Mike has so very eloquently said, you don't want to be waiting to make that preparatory work 2 to 3 months before. You want to spend the time, invest in advance, and think strategically. So Mike, thank you so much. And is there anything else that you wanted to say, or did we cover all the bases?
I think we covered the bases, John. Very, very happy to have had the opportunity to talk to you today, and hopefully let's stay in touch, and maybe we can have another chat over the next few months.
Yes, sir. Absolutely. Thank you very much.
All the best.